stock market's rigged. The United States stock market, the most iconic market in global capitalism, is rigged.
The stock market is often regarded as a reflection of economic activity, where stock prices are influenced by a multitude of factors, including supply and demand, company performance, and overall market sentiment. However, there exists a darker facet to the stock market that has gained substantial attention in recent years: market manipulation. Market manipulation can manifest in various forms, each characterized by unique tactics and implications. Knowing about these forms is a must if you ever plan on investing in something. First up, we have the basic pump and dump schemes. And no, I'm not talking about the crypto coins pump and dumps. This is much deeper than you think. This scheme involves artificially inflating the price of a stock to attract investors' interest. The moguls typically spread false or misleading information about a company's prospects, exaggerating its potential. Once the stock price rises substantially due to the increased demand they've generated, they short sell their shares at a profit, leaving your and my accounts empty. In stark contrast to pump and dump, short and distort involves driving down a stock's price. Manipulators take short positions in the stock, essentially betting that its price will fall. To ensure their bets pay off, they spread negative information, often false or exaggerated, to induce panic selling among investors, thereby further driving down the stock price. Now, this can be done in many ways, but what's interesting is that often these manipulators will first up the price, and as soon as they sell their shares at a high price, they start bad-mouthing the company just so they can buy a dip. Spoofing involves the placement of fake orders to buy or sell securities with no intention of executing them. This tactic is employed to create the illusion of market demand or supply, misleading market participants. Layering is a more sophisticated form of spoofing, where multiple orders are placed and cancelled rapidly to create confusion among traders and algorithms. But get this, it gets even more comedic with churning. Churning is a tactic that involves excessive buying and selling of a security by a broker. The primary objective is to generate commissions for the broker at the expense of the investor. The broker benefits from the increased trading activity, while the investor incurs substantial transaction costs. Unlike washing, that really disturbed how you view the market. Wash trading occurs when a trader simultaneously buys and sells the same security, often through different accounts, creating the appearance of high trading volume. This manipulative tactic aims to deceive investors and artificially inflate a stock's liquidity. Insider trading involves trading securities based on material non-public information. Insiders, such as company executives or employees, use their privileged access to get information for personal gain, often at the expense of uninformed investors. Front-running is a practice where a broker executes orders on a security for its own account before filling client orders. This unethical maneuver allows the broker to profit at the expense of its clients, creating a conflict of interest. In the digital age, with the proliferation of social media, individuals and groups have exploited platforms like Twitter, Reddit, and online forums to promote stocks and cryptocurrencies. Manipulators utilize these platforms to disseminate false information and rally support for their chosen assets, irrespective of their underlying fundamentals. Understanding the tactics employed by market manipulators is essential for both investors and regulators. These tactics can be intricate and are designed to deceive and exploit market participants. In some instances, manipulators work together with other market participants to execute their scheme collectively. They may engage in coordinated buying or selling, often involving large blocks of shares traded simultaneously to have a substantial impact on the market price. Manipulators often target stocks with low trading volumes because it is easier to move their prices. Thinly traded stocks are susceptible to rapid price swings, making them ideal candidates for manipulation. High-frequency traders may engage in manipulative tactics by swiftly entering and exiting positions to create the illusion of market activity. This can induce other traders to follow suit, exacerbating price movements. With the advent of social media, online forums and social networking platforms have become hubs for promoting stocks and cryptocurrencies. Manipulators use these platforms to disseminate false information and rally support for their chosen assets, irrespective of their underlying fundamentals. rules. Market manipulation has far-reaching consequences that extend beyond the immediate financial losses incurred by individual investors. Understanding these consequences provides insight into the broader impact of these manipulative activities. The most direct and immediate consequence of market manipulation is the financial losses suffered by investors who become victims of fraudulent schemes. Market manipulation undermines trust in the fairness and integrity of financial markets. When investors perceive the market as rigged or manipulated, they may withdraw their investments or become reluctant to participate in the market, leading to reduced liquidity and market efficiency. Manipulation distorts the true market prices of securities, making it challenging for investors to make informed decisions. Misleading price signals can lead to the misallocation of capital and inefficient resource allocation in the broader economy. Regulators must allocate significant resources to investigate and prosecute market manipulation cases. These costs are ultimately borne by taxpayers and can divert regulatory attention from other critical issues in the financial system. Perpetrators of market manipulation, once apprehended, face legal consequences, including fines, imprisonment, and damage to their personal and professional reputations. Companies associated with manipulation may also suffer reputational damage and become subject to shareholder lawsuits. Manipulative activities can create sudden and severe market volatility. Sharp price swings can trigger automated trading systems and exacerbate losses for investors caught in the turmoil. Market manipulation hampers the efficient allocation of capital by distorting prices. It discourages legitimate investment and can result in the mispricing of assets, affecting resource allocation in the broader economy. To combat market manipulation effectively, financial regulators and authorities worldwide have implemented a range of measures and regulations. These measures aim to detect, prevent, and punish manipulative activities, and thus preserve the integrity of financial markets. Financial markets rely on sophisticated surveillance systems to detect unusual trading patterns and potential manipulation. Regulators employ data analysis, algorithmic monitoring, and market intelligence to identify suspicious activities promptly. Companies are required to disclose information that may impact their stock prices promptly. Insider trading rules mandate that insiders report their trades to prevent illegal trading on privileged information. Regulators have established rules and laws explicitly prohibiting market manipulation. Violators face civil and criminal penalties, including fines and imprisonment. Many regulatory bodies offer whistleblower programs that incentivize individuals with knowledge of market manipulation to come forward. Whistleblowers may receive financial rewards and protection against retaliation, encouraging the reporting of illicit activities. Stock exchanges implement circuit breakers to temporarily halt trading when there are extreme price fluctuations. These measures aim to prevent panic-induced buying or selling and mitigate the impact of market manipulation. Regulators have introduced rules to address the risks associated with high-frequency trading, a domain where market manipulation can be particularly challenging to detect. These regulations include minimum resting times for orders and prohibitions on certain trading practices. In the European Union, MAD and MAR set out rules to prevent market abuse, including insider trading and market manipulation. While technological advancements have enabled regulators to become more agile in their fight against market manipulation, they have also presented challenges. First, the speed at which markets operate in the digital age means that regulators must respond swiftly to emerging threats. Manipulative tactics can evolve and adapt in a matter of seconds, and regulators must keep pace. Second, the global nature of financial markets means that manipulators can operate across borders. Coordinated market manipulation schemes may involve multiple jurisdictions, requiring international cooperation among regulators. Organizations like IOSCO play a crucial role in facilitating this cooperation, but challenges remain in aligning regulatory approaches and sharing information effectively. Third, the sheer volume of trading data generated in the digital age can be overwhelming. Regulators must have the capacity to process and analyze massive datasets to identify manipulative activities accurately. This requires not only advanced technology, but also well-trained personnel who can interpret the results of data analysis. Market manipulation can also have a significant impact on market sentiment. When manipulative activities are exposed or when investors perceive that manipulation is occurring, it can erode confidence in the market. Investors who feel that the market is rigged may become hesitant to participate, participate, reducing liquidity and potentially leading to wider bid-ask spreads. This in turn can make it more costly to execute trades, particularly for retail investors. Furthermore, the proliferation of information and news through digital channels and social media has made it easier for manipulative narratives to spread. False information can quickly go viral, influencing investor sentiment and driving trading decisions. One of the most high-profile examples of market manipulation in the digital age was the GameStop (GME) saga that unfolded in early 2021. The story centered around a group of retail investors on the Reddit forum Wall Street Bets, who banded together to drive up the price of GME stock. The group argued that hedge funds were excessively shorting GME, making it an attractive target for a short squeeze. They encouraged others to buy GME shares, pushing the stock's price to unprecedented levels. This sudden surge in price forced some hedge funds to cover their short positions at a significant loss, leading to substantial losses for those who had bet against GME. While this may seem like a case of retail investors exploiting market dynamics, it also highlighted the potential for coordinated retail investor actions to impact market prices significantly. It raised questions about market integrity and whether such activities could be considered a form of market manipulation. In response to the GameStop saga, regulators and market participants revisited discussions about the role of social media and online forums in influencing stock prices. It prompted inquiries into the potential need for stricter regulations to prevent manipulative tactics or to ensure that markets remain fair and transparent. The rise of retail investors, often fueled by information readily available on the internet and the democratization of trading through online brokerage platforms, has added a new dimension to market dynamics. Retail investors now have greater access to financial markets and can have a more significant impact on stock prices. While retail investors play a legitimate and essential role in financial markets, there is a fine line between speculation and manipulation. Speculation involves making informed bets on the future performance of assets, while manipulation entails artificially influencing prices through deceptive or fraudulent means. In the digital age, where information spreads rapidly through online forums and social media, distinguishing between genuine market enthusiasm and coordinated efforts to manipulate prices can be challenging. Market regulators face the difficult task of striking the right balance between allowing market participants to express their views and protecting market integrity. Heavy-handed regulation that stifles legitimate market activity can have adverse consequences, while lax oversight can leave markets vulnerable to manipulation. Recent discussions have revolved around topics such as short squeezes, meme stocks, and the role of social media influencers in influencing investment decisions. Regulators are closely monitoring these developments to determine whether they pose risks to market stability and whether regulatory adjustments are necessary. Market makers and liquidity providers are essential components of financial markets, ensuring that securities can be bought and sold effectively. They stand ready to buy or sell assets at quoted prices, facilitating market transactions. However, there have been instances where market makers have faced accusations of engaging in manipulative practices. This often involves market makers exploiting their privileged position to influence prices or execute trades in a way that benefits their own interests. For example, market makers may engage in quote stuffing, where they flood the market with a high volume of orders that have no intention of executing. This can create confusion among other market participants and disrupt the normal functioning of the market. Regulators are vigilant in monitoring the activities of market makers and liquidity providers to ensure that they do not engage in manipulative behavior. Striking the right balance between their crucial role in providing liquidity and preventing manipulative practices is an ongoing challenge. When market manipulation goes undetected or unpunished due to regulatory failures, the consequences can be severe. Regulatory lapses can erode trust in financial markets and leave investors exposed to fraudulent activities. But do you know what's even crazier? The case of Enron. The Enron scandal of the early 2000s serves as a stark reminder of the consequences of regulatory failures in overseeing financial markets. While Enron's collapse was primarily driven by accounting fraud rather than market manipulation, the fallout exposed significant regulatory shortcomings. Enron, once considered one of the most innovative and successful companies in the United States, engaged in accounting practices that concealed its massive debt and inflated profits. The company company's stock price continued to rise, and it was included in prestigious stock market indices. As the truth about Enron's financial mismanagement began to emerge, its stock price plummeted, resulting in massive losses for investors and employees who had invested their savings in the company's stock and retirement plans. The Enron scandal led to a wave of reforms aimed at enhancing corporate governance, improving accounting standards, and strengthening regulatory oversight. The Sarbanes-Oxley Act, passed in 2002, imposed stringent requirements on corporate governance, financial reporting, and auditor independence. This case illustrates the critical importance of robust regulatory frameworks and the potential consequences when regulators fail to detect or prevent market misconduct. While Enron's downfall was not a result of market manipulation, it underscores the broader need for effective oversight to protect investors and maintain market integrity. The GameStop saga mentioned earlier also highlighted some of the regulatory challenges posed by the digital age. While the events surrounding GameStop involved retail investors rather than traditional market manipulation, they raised questions about the adequacy of existing regulations in addressing novel market dynamics. One key issue was the rapid dissemination of information and investment strategies through online forums and social media. Retail investors on platforms like Reddit were able to collectively influence stock prices through coordinated actions and information sharing. Regulators had to grapple with whether these actions constituted market manipulation or were simply a manifestation of retail investors exercising their right to trade and express their opinions. Furthermore, the interconnectedness of financial markets meant that actions taken by retail investors in one corner of the internet could have a cascading effect on broader markets. Regulators needed to consider how to respond to these novel challenges while preserving market integrity. In response to the evolving landscape of market manipulation and the challenges posed by digital advancements, regulators have been proactive in adapting their approaches. These adaptations are aimed at enhancing market surveillance, investor protection, and the overall integrity of financial markets. Regulators have invested in advanced surveillance tools that leverage big data, machine learning, and artificial intelligence to detect unusual trading patterns and potential manipulation. These tools can analyze vast amounts of data in real time, providing regulators with a more comprehensive view of market activities. Whistleblower programs have been expanded and incentivized to encourage individuals with knowledge of market manipulation to come forward. Whistleblowers play a crucial role in uncovering wrongdoing and providing regulators with valuable information to pursue enforcement actions. Regulatory authorities have implemented measures to enhance transparency in financial markets. This includes requirements for timely disclosure of material information by companies and stricter reporting obligations for insiders to prevent insider trading. Regulators recognize the importance of international collaboration and information sharing to combat cross-border market manipulation. Organizations like IOSCO facilitate coordination among regulatory bodies worldwide to address global challenges effectively. The rise of cryptocurrencies has presented unique challenges for regulators. Many jurisdictions are working to establish comprehensive regulatory frameworks for digital assets to address potential market manipulation and investor protection concerns. Regulators are also engaged in efforts to educate investors about the risks associated with market manipulation and speculative trading practices. Empowering investors with knowledge can help them make more informed decisions and avoid falling victim to manipulative schemes. Regulators must strike a delicate balance between fostering financial innovation and ensuring market integrity. They aim to encourage the development of new technologies and trading practices while safeguarding against potential abuses.